Hey everybody, this is Jim at SP500chart.com. It's a little bit before 3 o'clock on Sunday afternoon, March 20th, 2016. This is the day before the first day of spring. At least I think the first day of spring is the 21st. Sometimes it's, I think, the 22nd if you go by strict astronomical guidelines. Well, whatever, we're very close. And we're going to take a look at the S&P 500 chart after I remind you that the website and the video are for educational purposes only. Nothing stated at the site or in this video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look at what happened this week, and I think I may branch out a little bit and take a look at some other things too to see what might be kind of underneath this market that could propel it up further. So let's take a look right now. Starting out on our typical 30-minute S&P 500 chart, I remind you this chart is in a logarithmic scale. If you have your own chart and it's in an arithmetic scale and you look at a long range chart, something similar to this, your lines probably aren't going to match up with mine. I use a logarithmic scale. What does that mean? Well, just very briefly, what that means is the same vertical distance, and let me just illustrate it like this. Let's say that distance right there represents an 8% move in the S&P. It's an 8% move if I put that line here, and it's an 8% move if I put that line there. In other words, the same percent, no matter where you are on the chart, is represented by the same vertical distance. What about an arithmetic chart? Well, if I switch this over to arithmetic right here, now you can see my lines don't work anymore. And if I put this line down here, that now represents about a 12% move. But if I put it up here, it represents about a 5% move. So you see, I believe people buy and sell not based upon the actual dollar amount, if you will, but I think that profit motives kick in as a function of the percent of gain. So there's arithmetic, there's logarithmic. So in other words, if over the past 3 years that are or 4 years that are encompassed in this chart, actually longer than that, 5 years, if everybody said I'm going to sell when I get a 20% gain and I'm going to buy when there's a 15% pullback, everything would line up in a perfect parallel channel because that 20% gain is always going to be the same vertical distance. It's been a while since I've gone over that, so I thought this might be a good time just to remind you that that is why I use a logarithmic scale. Now, as far as this week went, we were up a little bit. The good news is we closed near the highs of the week. If we zoom out and we look at a weekly candle, what is a weekly candle? Well, that means each candle that you see on this chart, and by the way, what is a candle? Why do they call these candles? Well, it started in Japan many centuries ago. I understand, from what I understand, it started when people in Japan were trading rice, is the way I heard it, and they started charting things, and they called these candles because you have the wick that is this line right here, and then you have the solid body. In other words, they have a tendency to look like candles, so we call them candlesticks. And there are traders who specialize in candlesticks. But I like, instead of doing a daily candlestick, I really prefer looking at a 5, 15, 30-minute chart because I think more is revealed in the intricate details that take place inside each of these candles than just what you see here. Okay? But The point being, we put in this candle back here in the second week, or was that the first week? In early February. This was called a hammer. A hammer is where you start at the high part of the range, you come down, and then you close near the high part of the range. That almost always signifies some form of rally. If you look on this chart, we have 4 hammers. We have one here that actually got back tested here, and then we had a second dip there, but that also formed a hammer. Then we had a rally. Okay, then we had a hammer, and almost the same thing back here. A little rally, a second hammer, then we have our larger rally, and that is what we've experienced. Really, if you go back to the middle of the week 6 weeks ago, from that point up, we have been up for 5.5 weeks pretty straight. If we look at that on a daily chart, there you see it. This is the week where we had that hammer. Okay, then it's been up in a channel ever since. And this week I've made a change in the chart, and that is I have made this line now our support line. Why did I do that? Well, because we have now set clearly a new short-term high that has come off the tag of this line here. So if we're looking at this chart and we're thinking we touched the resistance line, then we touch support, we touch resistance, we touch support, then we start head up for resistance again, that pattern is now defined by these 2 lines. And here it is. We touch resistance, support, resistance, support, and now it looks like we're headed back for resistance. Now there's something kind of interesting in this chart I want to point out, and if you've been following things closely, you'll know that I've been talking about the potential for this being either a parallel channel or maybe a rising wedge. If it's a rising wedge, then that tells us we should not be that this positive move should reverse fairly soon. And if it does, that we could find ourselves coming back to the levels that were in place before this wedge started to develop. And when was that? Well, that was way back when we were in the 18 teens. Okay? So that's what this wedge would say. But maybe instead of being in a wedge, we're in a channel, and this one dip back here that makes us think maybe a wedge is just something that happened out of range. That's possible. But I'm still keeping this wedge thing on the chart, and here's what we need to watch for this week. Often when you have wedges, the level of the apex of the wedge, and what's the apex? Well, that's where the resistance line and the support line meet. Often that level creates a technically important area. So if it's a rising wedge, that area is often resistance. If it's a descending wedge, that area is often support. In a few rare cases, I have bought stocks when the wedge has been extremely well defined, and it broke out and then pulled back. There have been times when, even though we're not on a trend line, but because we have come back right to that wedge apex, and if you watch the price action and see that that the selling is starting to slow down, and I'm talking about a descending wedge that breaks to the upside, then starts to slide back down. If it comes back to that apex level and the wedge is an absolute no-brainer, there've been times when I've said I'm buying this stock when it comes back to the apex, looking for a secondary sign of support, either a slowing down of the selling process or or maybe even a hammer candle or something like that. There have been times when I've said this is a buy. I remember Ford did that many years ago, back in 2009, 2010, whenever it bottomed. I think it was 2009. Ford came back, it had made a long wedge, came back. Unfortunately, I did not buy Ford. Had I bought Ford, that chart said buy it at about $1.50. I didn't do it. I waited a little bit later than that. But anyway, make a long story short, we're looking at the opposite situation now. We're looking at a potential rising wedge, and our apex level is at 2060, let's call it. So let's just be on the watch out in the week ahead to see if we get resistance at 2060. If we do, then we might need to come back and look at this and say, well, maybe the wedge is the driving force here. But if we don't, if instead we come up to this line here, then maybe the wedge is not the driving force, and maybe we are instead in a parallel channel. The question then becomes, how long will the channel last? Because this thing is rising up at an annual rate of about 130%. That's not going to last for months and months and months. Now, where are we in relation to our double bottom? What happened this week with regard to that? Well, here's our double bottom, and we had a small breakout over that. Then we pulled back underneath this midpoint neckline. But at this current point in time, we are more than 2/3 on the way to making the target from that double bottom, which means two things. A, I feel super good about not calling for a significant breakdown back in the second week of February when we got down into the low 1800s. You'll remember I was just within an eyelash of saying the party is over. But something told me, no, look at this level down here. Maybe we come down to test this low 1800s again, then we're going to rally back up. And by golly, that's exactly what happened. Then, you know, we were looking at this as a potential double bottom. That was confirmed when we broke out over this line. Now here we go. So, as far as the week went, you know, it's not a particularly beautiful thing, to be honest with you. We just sort of went sideways and then had a little rally on Thursday and Friday. That was really it. We did have a potential line of resistance right here, but because it was almost, not quite, but sort of, at least in the short term, a little bit horizontal. I mean, it's really not. It's going up at a clip of 43% annualized return, but we're only looking at it over a period of about 8 days here. So in 8 days, that 43% is really, well, it's almost flat. So looking at that, I thought we had a chance to get over this, and lo and behold, we did. Now we've got a short-term support line right here. So what I want to do is we'll keep an eye on this line, and I'm going to refine that, just make sure I got that just right. Oops, lost my little handle there. Let's put this up there just like that. Okay, so if we break through this line at some point, and we will, it wouldn't surprise me if it's this week. When we break through this line, then that would be the setup for at least a test of this line right here. So, and then if this line breaks, well, we have to ask ourselves, did we make our minimum target? If we made our minimum target already by getting up to 2090, then if this line breaks and this line breaks, we could be looking at a test of significant support back in the 1900s again. However, if these lines hold, the great thing would be if this market could get over 2090 and this level right here at about 2100, because the 2100 line right here, if we back out on this chart, you can see there's that line. And tell you what, oops, I didn't mean to grab that one. Let's put that back at 2090. I meant to grab that. This line right here, if we get over that, then it's possible that the past 2 years could end up being, rather than a top, it could end up being a large consolidation pattern that propels the S&P up. If we break out of it to the upside, we would be looking at a significant amount of gain in the months and possibly even years ahead. So still, really in the big picture, we are in between this line and this line, except for the fact that we traded under this one just a bit earlier in the year. But for practical purposes, I'm still keeping this line and as support and this line as resistance. The case could be made that maybe this line is support, okay? If we were to hit this line at 2090 and then back up a bit and then come back for another go at it, then you see what I'm saying? It's possible we could be setting up yet another inverted head and shoulders consolidation pattern, where this would be the left shoulder, this would be the head, and then maybe a right shoulder over here. But it's also possible that we're merely putting off the breakdown of a large head and shoulders top. So it is not a clearly bullish picture at this point, and it is not a clearly bearish picture at this point. We are in a state of, for 2 years now, the S&P has really been in a period of indecision. And that's borne out by the fact that just in the past couple of weeks did we get over the levels that we were at back in late summer of 2014, almost a year and 3/4 ago. So this has been a lot of back and forth here as bulls and bears battle it out, trying to decide, are we going to go up significantly or are we going to go down significantly? So guys, there you have it. That's it for the S&P. There's our move breakout over this green line here, which was resistance, moving up, flagged for about 4 days, then started back up. That was continued this past week. I told you I was going to look at a couple of other things. Because of my personal involvement in the biotech sector, I'm going to take a look at XBI, which is a biotech ETF, and that includes pharmaceuticals. And this thing has been decimated since summer of 2015. So I felt some pain there, but I want to take a quick look at that and see what's going on with XBI. Okay, here is a 4-day chart of XBI. This is a line of very, very long-term tops, resistance, and I just threw this line down here before we reach that bottom, and you can see that these two lines are almost exactly parallel. And actually, I think when I put it down there, it was parallel, but maybe I just sort of moved it when that bottom became a little bit more apparent here. Hopefully that's a bottom. You can see how XBI at one point was 90 back in the summer of 2015 and actually got down into the 44. So within a period of about 7.5 months, 7 to 7.5 months, had lost half of its value. That's a lot of the weakness that we saw in the S&P and in the Nasdaq. If we zoom in on this to a daily chart, you can see here's that 90. We see a little head and shoulders top here, a breakdown, a back test, really sort of to that area of the breakdown, another leg down, bear flag, another big leg down. Then we started to go back and forth here. What I'm looking for in in XBI is if we can get over this line right here, and especially if we can get over 55 in this, then that'll put us over this line, and I think that may bode well for a recovery in the biotech sector at large. If we move into a 30-minute chart, you can see there was an inverted head and shoulders pattern right here. Interesting to note, okay, head and shoulders pattern, the pattern had a depth of this depth right here. It looked like it was breaking out, reached about 54 and change, then the breakout failed. The pattern failed. And I'd read one place where people said when a head and shoulders pattern fails, you take the depth of the pattern or the height of the pattern, and you measure that, and then you use that as a ruler. You put it on the height of where the pattern was when the failure started to take place, and that will tell you the minimum downside target. And I just think it's interesting to note that that is exactly where the XBI ETF started to find some support at 46 and change 2 weeks ago. I just thought that was really interesting. Let's take a look at something else real quick. I'm just going to use the Goldman Sachs oil chart here as a proxy for energy. And what's interesting here is it would look like it was in a descending wedge, but we got down underneath this lower support line. And what do we know about when we get down underneath a descending support? A lot of times that's a sign of a bottom in and of itself. So we've rallied nicely here in energy over the past month or so. What I would be looking for is if you're comfortable using this as a proxy for energy, you may not be. I mean, maybe it's not the best thing to use, but it's easy for me to keep an eye on this, so that's why I do it. But anyway, if we look at this chart and see this resistance line right here, if we were to get up over this line, then I think we could probably say oil and by extension energy is making a bottom. So that's just something I wanted to show you. Those were two sectors that since the middle of summer of 2015 have really been leading the markets lower in a very big way. So if we look at oil and we look at the biotech industry, the biotech ETF, I think that may give us a clue as to where our weakness came from, and therefore give us a clue as to where our strength may come from in the weeks and months ahead. So I hope that makes sense to you. So just to recap, if you look at this chart, and this chart will be posted under the live charts section at sp500chart.com. By the way, that's one of the things you get when you subscribe is I update this chart. You go on and you log into freestockcharts.com, which is not me, it's an outside service, but this chart is available with all of these trend lines, and it is updated in real time. So you get to watch this thing if you choose to see how these trend lines work, or it's sometimes, let's be honest, how they don't work. But regardless, they give us some clue as to what's taking place in the S&P. If you sign up to sp500chart.com, you get this chart updated daily. You just click on the link, and it loads up with my trend lines, and you sit there and you can zoom in to a 1-minute chart and you watch this thing zigzag around all around the trend lines that are on this chart. And it's a pretty cool thing when you think about what you used to have to do a few, just 10, 15, especially 20 years ago. That was just a dream, and yet here we are. It's a reality now, and it's at least freestockcharts.com. It's free. So hey, I encourage you to go check that out. I also encourage you to sign up at sp500chart.com for the daily S&P 500 updates if you haven't done so already. So guys, there's your video for the week ending March 18th, 2016. Let's see if we stay in this channel this week, and let's see, we've got a shot this week of making our 2090 target. And if we got more than that, we've got a shot at creating potentially a setup for not just 2090, but a setup for a run to 2400. So that'll be exciting to keep an eye on. So I hope you'll sign up for sp500chart.com so you can keep an eye on this with me on an ongoing daily basis. So there you have it. Thanks for watching. Take care, and let's see what this week brings us.